Hi, everybody, and welcome to Parents Engaging Parents, Beloved Community Check-In. My name is Erica Beverett, and I'm checking in from Mount Laurel, New Jersey. We are here. Welcome to the parents, community leaders, to PEPNJ's Beloved Community Check-In today. It is December the 6th, and it marks a significant gathering as we unite on the live stream platform jointly presented by PEPNJ and Industrial Bank to deliberate on pivotal issues that align with our collective mission and vision. Firstly, I'd like to express our immense gratitude to our sponsors, a special acknowledgement to the PEPNJ Grassroots and the Real and Powerful Leader Council, whose unwavering support has been so vital to the work that we've been doing. Also, our sincere thanks to Industrial Bank and the Terrell Fund for their dedication to our community. PEP's mission, as many of you know, is committed to enhancing civic awareness and proactive community action, deeply rooted in the interests of parents and community leaders. Our vision is to cultivate and empower leadership groups capable of investigating transformable change, and we are committed to achieving this through collaborative community engagements across New Jersey. And these are, we are trying to extend our efforts nationally as well. So today's agenda includes an introduction to our esteemed partner, Karen Highsmith. And before we welcome her, we're going to delve into our focus on financial empowerment and home ownership. Let's highlight some of those, our upcoming events as well. So we did have to, of course, give a big thank you to Jackie Atkins and Give a Kid a Dream New Jersey team for the Atlantic City Coat giveaway this past weekend at the Showboat Resort. And we wanted to send our biggest acknowledgments to Senator Troy Singleton and his team, alongside Burlington County commissioners and their team as well, for their generous coat donations in West Hampton, New Jersey, of course, and that's actually in Burlington County, my county. And shout out to our ongoing efforts in East Orange at the Whitney Houston Academy of Creative and Performing Arts, and also to Edward T. Bowser Academy of Excellence. We have hosted, actually this week, we're going to be hosting two giveaways, one which was tonight, which is why Mr. Frazier couldn't join us, but I'm sure he's going to definitely jump in. And of course, kudos to Angela Cares, who we're going to be having a upcoming event on the 8th, which is on this Friday in Hudson County in Jersey City. Of course, we are going to be collaborating with Patterson as well. We are going to be collaborating with Madison Avenue Baptist Church and Pastor Eric and community leader Shaniqua Lemon of Madison Avenue Baptist Church. They are going to be contributing with us, collaborating with us to make sure and ensure that our babies there in that part of Jersey also have the opportunity to have warm winter coats as well. And then also we are going to have another upcoming event in Passaic County with Pastor Devon Horton at the Williams Chapel AME Zion Church in Passaic. And that's going to be coming up on the 22nd of December. And so definitely look out for our events there. And we're going to circle right back to Orange. In Essex County, we're going to be partnering with Councilman Montague and Councilman Ross there in Orange to give away coats as well to children to ensure that they have all of the things that they need for our upcoming weather. We know it's already weathering outside, so of course we want to make sure that our babies are served there in Orange, and that's going to be happening on Saturday, December 16th. Okay, so we also, I wanted to, for a national discussion for today's focus on the spirit of giving and the importance of financial management during our holiday season. In the Financial Empowerment Series 5, which is home ownership, we'll be exploring various aspects in that journey to home ownership. So we're going to include reflections from first-time home buyers, considerations to keep in mind, insights into mortgage payments, and the overarching benefits of buying a home. So join us as we embark on this insightful journey with Karen Highsmith, VP of Organization Management at Industrial Bank, to ensure our understanding and empower our community with knowledge and resources for a better future. Let's make the most of this opportunity to learn, share, and grow together. And thank you for being a vital part of this conversation. So, with no further ado, there you are, Ms. Highsmith. How are you today?
I'm well, thank you. Thank you for having me back. This has been an exciting event, these series, presenting information to everyone and getting the insightful questions and feedback. It's been a wonderful experience. So I'm looking forward to this one. This one I think is one of my favorites because it's about home ownership. So I'm hoping that everyone will find some value in it as we go through it. And if there are any questions, please don't hesitate to ask a question, send a comment, because that just makes it more interactive. And I appreciate being able to have that level of engagement.
Oh, no, we appreciate you for being with us tonight.
So today we'll talk about home ownership. There's a lot of good information about home ownership that I'd like to share with everyone. This is series 5 of 7 of our series. Next week we'll do future finance savings, and then I think our last one is identity theft. We tried to put them in some kind of sequential order to kind of build on the information from the previous series. So this one is really helping us to understand what it takes to own a home, give some general information about what you should think about and consider as you contemplate that investment. It goes over some of the terminology about the mortgage process and the lending process and some of the items that you need to consider when you're looking for pre-approval and where you want to live. So I'm hoping that you find value in what we're going to offer. So I'm ready for you to open it up, Erica. Thank you. So today we'll go over, some of your reflections, things that you need to consider. What makes up a mortgage payment? The benefits of buying a home, the qualifications for FHA and conventional mortgages. We'll talk about what the differences are, and then some steps to really begin saving for a home purchase because it's one of the largest purchases you'll ever make. What it takes to get pre-approved, the hidden costs in buying a home, and then what is PMI and what are points, and then mortgage transaction terminology. Next slide. So what are your reflections? So why do you want to become a homeowner? I think that's the most important thing you need to ask yourself. Are you doing it for long-term security? Do you want to save or spend money on homeowners insurance, property tax, or maintenance repairs? Some people who rent for a lifetime, they build wealth and security because the money that they would put into investing in a home, they save. So you have to really understand why home ownership is important to you. Are you going to live in the home for at least 5 years? Do you contemplate that, in 5 years or less, you'll be relocating, or you might be getting married, or there might be other life changes that you'll have to take into consideration. Are those things going to impact your decision on purchasing a home? What about the maintenance costs? So there's a maintenance cost associated with home ownership. And what the rule of thumb is you would want to try to save at least 10% of the home's value in a savings account so that you can have the money for those unexpected maintenance repairs that might come up. And then, can you afford to lose value on your property? I think there was a time when all of the mortgage industry almost crashed. And so there were people who just purchased homes, and their homes weren't as much as what they paid for or having to pay for them. So those are something that you have to take into consideration and reflect on, because if the value drops, or if you go to sell and you don't get as much for the home that you thought you should get, then that's going to impact whether or not you really want to take that journey. Oh, so this page looks like it's okay. 4 parts to a mortgage. So there are 4 things that make up a mortgage payment. It's your principal payment, which is the actual cost of the home, the interest payment, the money the lender charges you for lending you the money for the home, insurance, which is something that lenders require you have, and taxes, which are real estate taxes based on where you live. And the base mortgage is the principal payment that you make on the loan. And then the interest is what the lender charges you for lending you the money. And then the homeowner's insurance protects the lender in case there's any damage to the home. Now, property taxes vary, depending on where you live. Some states have low property taxes. New Jersey has higher property taxes, and the taxes depend on where you're going to live. So once you decide where you're going to live, you'll be able to get a better sense or do some research on what the property taxes are in that area. And then lenders expect you to try to put up at least 20% down on your mortgage. If you do that, you may not require mortgage insurance. It's required that you have mortgage insurance because they want to make sure that they're protected in case something happens to the home. The benefits of buying a home. Well, one of them is equity and preparing for retirement. Some people purchase a home because they think about, in 30 years, 15 years, the house could be paid for. And then the only thing they have to pay out are the taxes and insurance. Buying a home has tax benefits because you can deduct from your taxes your mortgage interest and your property taxes. And if you're a first-time home buyer, you might even be able to deduct some of your closing costs. The deductions can really help you if you're in a high bracket in terms of income, if you're an empty nester and you no longer have dependents. Having a mortgage interest and property taxes on your home can help with your tax payments. And then the fixed rate monthly mortgage. It means that you know how much you're going to be paying over the period of 15, 20 years for your home and your monthly payments. The long-term stability, while knowing that you're going to be in one location, can give you peace of mind. And it's important to do some research, finding the right lender. So you need to do some research on, meeting with a loan officer to get a better understanding of what you might be eligible to borrow, the best type of loan for your situation. meeting with several financial institutions to kind of get a sense of how each of them might treat your loan differently. And then making sure that whomever you choose, that you get the best personalized service and the most affordable rates. FHA, Federal Housing Administration. So this is typically some of the best type of mortgage that first homeowners buy or use. The down payment is small. It's only 10% if you have a credit score between 500 and 579. The down payment can be 3.5% for a credit score of 580 and above. And the DTI, which is debt to income. So lenders look at your debt to income to see how much mortgage you can qualify for. And that's typically for an FHA mortgage about 43%. And that helps them determine what your monthly mortgage is going to be. And then the term of the loan is 15 to 30 years. And part of what you have to verify or be able to verify is that you've had 2 years of verifiable income. So conventional mortgages. So conventional mortgages can also be used for first-time homeowners. And these are just two types of, but there's all kinds of mortgages. So there are VA and USDA loans, which people who are using a conventional mortgage can typically apply for. And some of them have zero down, but they have additional requirements. And your VA loan is typically for service members, veterans, and eligible surviving spouses. And the qualifications for these loans are slightly different. The minimum credit score is about 620. Your down payment is about 3%. And your debt to income can vary, but most lenders like it to be less than 50%. And the term of the loans differ here. So it can be 10 years, 15 years, 20 years, or 30 years. And the longer your term is, the smaller your mortgage payment is. And if your mortgage is shorter in terms of the term, typically the amount that you're going to pay every month is going to be higher, but then you own your home sooner. Steps to begin saving for a home. How much do you need for a down payment? You think about the how much can you afford every month? The size of the payment impacts your mortgage, and you also have to factor in fees. And then you need to put your savings plan into action. You create a plan, starting with the steps that it takes to purchase the home. You adjust the plan. So you will want to have to put it in a separate account and try to save or reduce your expenditures by at least 10%. Reduce your debt each month. So if you can, begin to pay off credit card balances or other types of loans that you might have to help reduce your debt. Open a dedicated account. It's important to put that money aside so that it doesn't impact anything else you're doing, and you can see it grow to help you towards your saving for a home. And then check your plan with what's happening in the market. The mortgage market is always changing. Interest rates are always going up or down. They have terminology like, is it a seller's market or is it a buyer's market? So you want to be able to keep up with that, because depending on what kind of market, where interest rates are going, you might have to adjust your savings plan in order to make sure you're going to meet your goal that you want to achieve to purchase your home. Adjust and maintain your savings plan. So it's important to plan for unexpected changes that may require that you adjust your savings plan. Save all the extra money that you can. So if you get a tax refund or a bonus, try to put as much of that aside towards your home savings goals, and then maintain for savings. So practice living under your new financial plan. So if you've reduced your credit card debt and you've paid off personal loans and you're saving 10% or more, try to maintain that until you reach the goal of purchasing the money you need to purchase your first home. So how do you get a mortgage pre-approved? So what is that? So it's a way for the mortgage company to get an understanding of what you qualify for. You get a pre-approval letter, and that letter is good for about 60 to 90 days. And if it expires and you still haven't found a home, you can always get it reissued. And then who can help you obtain a mortgage pre-approval? So that's a lender or a loan officer. You can work with multiple financial institutions to make sure you're getting the best term. And then lenders include banks and credit unions. Who should get pre-approved? Anyone using a mortgage to execute the purchase of a home, which is most of us. Most sellers won't accept offers unless the buyer has a pre-approval letter. What are the steps to getting pre-approved? Well, when you sit down with a lender at your financial institution or a credit union, they'll ask for certain information to begin to document what your income is. So it's a W-2 statement. They'll want 2 years probably of your W-2s. And then they'll want pay stubs for your current pay stub, your driver's license or state ID, and your social security number. And they're going to run your credit check to kind of put it all together. And then they'll do your debt to income ratio. And that's when they'll send it to what they call an underwriting group. And some lenders use automated systems where they'll just key your information into a system. Others will manually underwrite it to see what you might actually be eligible for in terms of the amount of a loan.
So we have one question from Muta, and he said that home ownership, or he made a statement that home ownership has just been taken out of our practical reach in Newark. What are your thoughts on that?
Well, I think home ownership in New Jersey can be challenging. One, because our property taxes are so high. And then in certain communities like our cities are what you call I guess the amount of homes and the type of homes may be somewhat limited. And Essex County, being our largest county in the state, has some of the highest property taxes. Mm-hmm. So when you put all that together, it can be somewhat challenging. The other thing is that, New Jersey does have some first-time home ownership programs where you can get up to $10,000 in a grant that doesn't have to get paid back, that can go towards your closing costs. So that can be helpful. But again, the cost of homes where there are a short supply and high taxes can make it really, really challenging in our cities. So yeah, it's a true statement that it is challenging if you want to live in the city and purchase a home. Sometimes it requires that you look slightly outside, of Essex County and maybe, weigh the commute. if you move to someplace like Edison or someplace like that where you can still have access. But it's a lot to take into consideration, and it does make it somewhat challenging.
Yeah. Muta, we thank you for your comments. And he also says that the median household income in Newark is $41,000, and you may be able to get a approval for $200,000, but it's not enough because a lot of the homes are like so inflated, like the prices are high, very high.
And he is so correct. He is so correct. And to make matters a little more challenging is you have rental properties that cost as much as a mortgage on a monthly basis. So when your rent is like $2,000 to $3,000 a month, and you don't qualify or can't find a home in that same area to help offset or use that $3,000 towards your paying yourself in a home ownership situation, it makes it even more challenging. So it's true. Purchasing a home in our largest cities can be quite challenging.
Mm-hmm.
Thank you for that.
Thank you
I
for that.
appreciate
Yeah.
that. So what are the benefits of getting pre-approved? It gives you insight on what you qualify for. It makes your offer for a home a lot stronger, and it makes you more competitive. And they can expedite your timeline to closing for a home. So anyone that is interested and can overcome some of the challenges may want to consider that. Hidden
Hold on a
costs.
second.
No,
I'm sorry, I go back.
no, you're
I
good.
jumped the gun there.
No, Erica, you're doing perfectly fine. Thank you so much. So it's important that you do get pre-approved because it helps you navigate the market, and it helps you understand, well, if I can't go to Newark, can that same dollar help me in other parts of the state? So it's just something for you to get as a tool to help you navigate the market and know what's going to work best for you and your family. So there are hidden costs in buying a home. And I thought this was important to, where are we? Okay, I thought this was important to share because we don't recognize or always get told by the lender what some of the hidden costs are. So say you find a home, the first thing they're going to want you to do is get an inspection. So there are several types of inspections. So they inspect on the condition of the home. They inspect for any kind of pests in the home. And then when they do the inspection on the home, they're checking to see if there are maintenance repairs that have to happen. So that's one of the hidden costs. Closing costs. So your closing costs can be 2 to 5% of your total purchase price of your home. And this includes the fees to the lender, any administrative fees. You have to pay for the appraisal. Then there are the attorney fees, and then the filing fees. So all of those are on top of your down payment. And then your taxes and insurance. So one of the things that I put in the back of the presentation for you to do some additional research on is escrow. So most purchasers and lenders will want you to put money in escrow for your taxes because they want your taxes and your insurance to be part of your mortgage payment. And so that money has to go into escrow. So taxes, insurance, some lenders, depending on how much money you put down and the type of mortgage that you take out, will have mortgage insurance. which is not like you having mortgage insurance to pay for the house if something were to happen to you. This is the lender's mortgage insurance that they want you to take out to protect them in case something happens to the home. And then repairs. So if that inspection comes back and says, oh, the air conditioner, isn't working, or the water heater isn't working, or you need gutter cleaning, whatever they come back and say, those are repairs that will have to be added into your initial cost. Now, sometimes you can get the seller to pick up some of that cost, depending on the price of the home and the condition that comes back through the inspection, especially if it's something that they were aware of. And that's why when you go to purchase a home, be mindful of a realtor that will come back to you and say, oh, here's an purchase as is. When you see the purchase as is, that can be a red flag that there might be some real costs associated with making some of the repairs. And then the last hidden costs are utility costs. So when you own a home, you have to pay for your water, you have to pay for the sewer, and then you have to pay for trash pickup. So those are things that you don't necessarily, or you may not have to pay for as a renter, but those are added costs. And, homes cost more to heat than apartments do. And then the other thing is consider high efficiency appliances. So these are all things that you want to kind of factor in, as maybe not to a level of detail that you know exactly what they are, but be mindful that you need to have extra money in your savings to help offset some of these additional costs. What is PMI? So PMI is private mortgage insurance or mortgage insurance premium. So FHA calls it mortgage insurance premium. Other lenders call it PMI. This is insurance that when you have a conventional home that you're purchasing, you're using a conventional loan, my apologies, they want you, and you don't have 20% down, they might say, well, in addition to lending you the money, we're going to also ask you to put in PMI. So that's an additional cost that you have to have when you go to purchase the home. Does your PMI ever go away as you pay down your loan? Yes, it depends on the kind of PMI you get offered by the lender. Some lenders have what they call upfront PMI. So they say, okay, here's a flat lump sum that I need you to pay to get this loan and purchase this home. Others will factor a certain part of that money into your mortgage payment so that it might increase your rate and it might also increase your monthly payment. And mortgage insurance for FHA, as I said, they call it the mortgage insurance premium, MIP, as opposed to PMI. And can you take out a second mortgage instead? Not if you're a first-time home buyer. And if you own a home and you're trying to refinance, you might find yourself in a situation where that lender may also ask you for PMI if the value of your home isn't at 80%. So they want 80% of your equity in order to not have you take out any additional homeowners insurance. That's an important thing to remember. Points. So here's another interesting terminology that you'll hear. So what is a point? And what does it mean to buy a point when you're purchasing a home? So points are basically allowing you to buy down your interest rate. 1 point is equal to 1% of the loan amount. So as an example, 1 point on a $200,000 loan is $2,000. And so it has like I want to say it's like a mixed bag where it has some value in terms of allowing you to purchase your house at a lower interest rate. It also can increase the amount of money that you need to bring to closing. Do points add to your closing costs? Yes, they do. Because you're closing with the points plus your down payment. So if you were putting $10,000 down, but you wanted to reduce your interest rate by 1% because it was maybe 6%, but you'd like it to be 5%, and the house is at 200,000, well, that's another $2,000 you have to come up with when you go to close. Is it worth putting down a smaller down payment to buy points? Well, 20% of the home's value is at signing. So if you're putting down 20% on your down payment, the points can then reduce your monthly payment. If you're a first-time home buyer and you're, using a more of a 3% down or a 3.5% down, and you're, looking to qualify for some of the states, first-time home buyer programs, then, buying points may not be what you want to do because you're trying to go to the closing table with the least amount of money coming out of pocket so that you can get into the home that you want to get into. Can you negotiate points with the seller? Well, sometimes. Sometimes a seller, depending on, how eager they are to sell the property, they might help you offset some of your closing costs by paying for a point. Sometimes buyers and sellers can negotiate on, who's going to pay what portion of closing, if that's what they're willing to do. So it depends on the home. It depends on the seller. It depends on the lawyer and the real estate company that you're working with, and how things are actually negotiated on what you can get the seller to do. If the seller is going to pick up some of the maintenance costs, they may not be as interested in picking up the costs on points. So it depends on the conditions that you're going into when you're purchasing that particular home. So I apologize for some of those slides being empty. I think the print might have been a little too light. But one of the things that I'd like to share is, I shared this website before, Enrich. And what I wanted to show you is that on the Enrich platform, which is free, and it's an industrial bank platform, it doesn't cost you anything to open that account and peruse through all of the wonderful information. But on home ownership in particular, there are different topics that you can explore. So you can get more information on escrow. You can get a better understanding on what it takes to for the paperwork, part 1 and part 2, because there's a lot of paperwork in purchasing a home. And then what can you expect when transitioning from renting to owning a home? And then this is interesting, fixed rate versus adjustable rate mortgages. That's a really big one because, a fixed rate is like, well, the interest rate on the home is 5%. It doesn't change. It's 5% no matter what. The only thing that changes is what the property taxes are, and that can impact what your monthly number is or how much goes into escrow. But that's your fixed rate. Your adjustable rate mortgages, show that the rate may change after 5 years, depending on what kind of adjustable rate mortgage you choose. So there's more information that goes into a lot more detail on those two subjects on the Enrich platform. And then special mortgage comparison. So, it gives you the opportunity to compare. Is it worth going into a fixed rate or an adjustable rate or a balloon rate? There are all kinds of rates around purchasing a home. And this special mortgage comparison will give you that level of detail, either in videos or articles, and then the pros and cons to common types of home mortgage loans. So we talked about a few. We talked about VA, FHA, we talked about conventional, we talked about USDA. So the other thing to be mindful is FHA and VA are government-backed loans. So those loans and Fannie Mae, those loans are backed by the government. Most other conventional loans are backed by private lenders. So that's when, Industrial Bank or Wells Fargo or TD Bank, they're private lenders. And so they can offer you those other loans, but they can also offer you loans that they back. So it's important to understand the types of home mortgage loans that you can have access to. And little known ways to reduce your mortgage. So once you get a mortgage, you really want to understand how to control those costs, and are there ways to reduce your mortgage over time? And then homeowners insurance. This is another important one because, not only are you going to need the homeowners insurance that the lender is going to require that you have. Once you get in your home, you're going to want to make sure your homeowner insurance is not just covering the structure, but is also going to help cover some of your belongings on the inside of the home. And so, or what happens if there is a need for a repair? I give you an example. I have my home, and one day I woke up and my wood floors were covered with water. So quite naturally, my homeowner's insurance kicked in to allow me to replace, the wood floors. But those are the types of things that the lender is not concerned with because I'm paying the mortgage every month, and I'm paying my homeowner's insurance cost is included in that mortgage payment. But my insurer, State Farm, as an example, I made sure that my homeowner's insurers covered the things inside the home that impacted how I lived in the home. So that's a good thing for you to, take a deeper dive and take some time to look into this. So I hope that you found this information helpful. If there are questions or comments, please share. I'm open to, an interactive dialogue to help you get as much value of this information as possible.
Thank you so much for that, Karen. I know that I have a question, and one of my questions was typically how long can you wait to ask to remove PMI?
So it depends on the kind of PMI you have. Some mortgage companies, when they give you the PMI, they'll say, okay, so after 2 years or after 5 years, depending on the size of the mortgage, your PMI will go away. You would have paid it down. So it depends on the particular circumstances. But yes, it doesn't last 30 years and it doesn't last 15 years. It usually lasts a certain period of time. And what the lender is doing is they're examining how well you're making payments. So if you're keeping your payments on time and everything is going well, then after a certain period of time, the PMI will disappear. But
Okay.
you have to request it. They're not going to do it automatically. So you have to contact your lender and say, okay, I checked my mortgage payments. My PMI should be up. Can you remove it? Because if you don't request it, they won't remove it.
Wow. Okay. I'm going to go ahead and add Tawanda to the screen. She's backstage with us here from Leaguers, and she has a question.
Hi, Tawanda.
Yes, hi. Okay, my question tonight is often I see a lot of flyers for first time home buyers program.
Mm-hmm.
So my question um, is it good? Like, what benefits are there to go into a first time home buyers program versus going to a lender?
So that's an excellent question. So there are certain things. So when you work with a realtor, right? Your realtor is really trying to get you the best situation possible to get into the home, because it's him and your lawyer's job to kind of get you into the home. And what the realtor can do is they can work with a mortgage company. Some of them have companies that they work with, and they'll say, okay, what programs are available for this type of what mortgage do you have that for this particular buyer, and then what first time homeowner programs do you have. So I know someone who recently purchased a home, and they purchased a home in South Jersey, and they went through a realtor and a lender that was able to give them like 3% down and 10% towards their closing costs. So when they walked into the closing, the value of the house was like $130,000. So, they walked in and they didn't have to put much down. I think they had to come to the table with like $5,000 or $6,000, and they have $10,000 paid toward their closing costs, and that helped with their escrow, and their monthly mortgage plus their HOA fees was under $1,000 a month.
Wow.
Right, right. So first, depending on where you live,
Mm-hmm,
it
mm-hmm,
has an impact. So this particular person that I'm familiar with moved to Camden County,
okay.
and the housing market, they were able to find a nice townhouse in Camden County that was like $130,000. Didn't have a lot of repairs because the seller had fixed it up pretty much. And so they can stay as long as they stay in the home for the
Mm-hmm,
first 5 years. That's one of the conditions of a lot of those first-time home buyers programs, is they want you to commit that you're going to stay in the home for the first 5 years. And if you don't, then you have to pay that money back. But
right.
if you do, you don't have to pay that money back. And then that home is yours to either stay there, sell, rent, or whatever suits you best. But yeah, the programs are worth it. And you can, before you go to a lender, as part of your research, you can go to the state's website and look at first time home buyers programs, and they'll tell you what programs are available in the state of New Jersey. And a lot of states have these types of programs, because some of them are government funded. So there are, all kinds of programs that they are definitely worth it.
Okay. Thank you.
You're welcome. Thank you for the question.
Yeah.
And then we have Karen Patrick, who's on with us, and she asked, may I ask about what the PMI is? If you can just give us a quick snippet of that again.
Yeah. So PMI is that additional property insurance that the lender wants you to take out to protect their interest in the home because you didn't pay 20% down. So if you didn't go to the closing table with 20% down on the home, most lenders are going to ask you to put additional insurance, and it's time constrained. So you won't be doing it for the life of the loan, but you'll be doing it for a short period of time. I hope that helps.
Okay. And then we have a comment from Aisha, and she says, "You can find a home under 250,000. You just have to be willing to do your own upgrades on most of them," which is
That's
true.
yeah, that's true. That's
Mhm.
true. And it depends on where you are. And then some homes, I don't know if it's still around, but HUD used to have sell homes, and their homes, they used to help the homeowner with the fix up of the homes, depending on the condition when they first purchased it. I don't know if that program is still in effect, but it really does require doing research. The more research you can do to kind of help understand and navigate your situation and what's going to be best for you, the more informed you can be about what to do and where to go and what to use.
And I just love how they put so much more regulations on how much they give you that pre-approval letter for, because I remember I think it was probably in about 2001 to they when I went to go purchase a home, they gave us an exorbitant amount for the pre-approval letter, and we knew in our minds at that time, like, there is no way that we could possibly afford that. So please, everybody, when you're getting your and I know they put restrictions, I would think by now they put restrictions on how they give out those pre-approval letters, and that they're not so exorbitant. Like, I think they gave us probably, and we weren't making anywhere close to what our incomes are now, but it was just really exorbitant, and we knew that there's no way we can pay like a $3,000 mortgage at that time when we weren't even bringing in $3,000. So, like, please, everybody, be mindful of your budget and how that's gonna, how that works for you.
Yeah. And now I think so, prior to, during that whole mortgage industry bust, when everything
Mm,
went upside down and, it almost destroyed the housing industry, you had a lot of predatory loans out there, people doing all kinds of unscrupulous and unethical things in terms of, allowing people and kind of tricking people into believing they could afford more than they actually could. So there are a whole bunch of new rules around, how they can't do that. And there are also a whole bunch of disclosures. So one of the things that happens during the process is they have to give you disclosure letters on what they're saying they can do. And then the other thing is recognize that the pre-approval is not necessarily the actual mortgage. Remember, we talked about, I think it in one of our other series, is that, the lender is doing what we call soft inquiry when they give you a pre-approval. And it's
mhm.
only when you sign that you accept the loan that they're doing a hard inquiry on your credit. And that's the one that changes everything, because now they're like, I'm not just guessing about what it looks like. You look kind of good. But now when I go to have you sign on the dotted line, that's when everything changes. So, be, as Erica said, be mindful, of what you really can afford, and don't let people give you something that that isn't factually true. So it's important. So yes, Erica, thank you for that comment, because that is very, very important for people to be mindful of.
Okay, and I have one more comment, and Aisha just mentioned that municipalities are offering lead abatement and home improvement assistance. So definitely take a look at your county's websites, your city's
Yes.
websites, to see what programs are available for you.
Yeah, that's a good one. That is a good one, because lead abatement is really important, especially if you're purchasing an older home. That's
Mhm.
very important.
Okay, well, Ms. Tawanda, do you have any other questions? No, you're good to go? All right. Well, I'm going to just thank you all once again for tuning in to Parents Engaging Parents and Industrial Bank's financial engagement empowerment for you. Tonight was home ownership. We thank you for tuning in. And of course, you can check this out again. You could rewind it. You can fast forward it. It's going to be there on our website, on our social media platforms here at Facebook, also on YouTube. If you might have missed a little snippet of it, definitely take a look back. We have like the full explanation of PMI. I know that was one of the questions, and um, I see one more that's popping through, and then we're gonna close out with that one. But here we go, and it is what causes your city taxes to go down. Ooh. Has
Yeah.
anyone
So
heard of their city taxes going down?
look, yeah, the more home ownership you have in the municipality, the better it is for that particular city, because property taxes are income to your municipality. So if your city doesn't have a lot of property taxes that kind of offset, some of their costs, then things go up in other ways, or services can disappear. So yeah, city taxes can go down if everyone has the ability to have more home ownership. That's a good statement. Thank you for that.
No, thank you, Karen Patrick. All right, and of course, please go ahead and hit the donate button if you can. $1 makes a difference, $2 makes a difference, $3 makes a difference, and more. It makes even a better difference for the work that we're doing here at Parents Engaging Parents. And I'd like to thank everybody once again for tuning in, to Wanda for hanging out with us tonight, and everybody have a great night.
Thank you.
Bye.
Goodbye, everyone. See you next week, hopefully. Bye bye.
Bye bye.
Next week.